Welcome to DWS Market Update. Cheap money is generally considered as providing a good tailwind for many markets. However, given the spike in inflation rates, central banks were forced to raise interest rates sharply, thus abruptly putting an end to cheap money. Markets now are eager to see interest rates fall again. For quite some time, markets were expecting policy rates to be cut again as early as 2023. We did not share these expectations. However, we could well imagine that rate cuts might happen next year. This expectation is based on one key assumption, which is that the current monetary policy stance is restrictive. When we talk about the monetary policy stance, we are referring primarily to policy rates, such as a Fed funds rate of 5.5% or an ECB deposit rate of 4%. Technically speaking, restrictive means that the current policy rates are above the neutral interest rate. As simple as the statement might sound, it is nevertheless quite important. After all, if that assumption is correct, many other forecasts are basically derivatives, such as that the economy is weakening or that the labor markets are weakening, and in particular, that the inflationary pressure is easing again. We believe that policy rates have seen their peak for the current cycle. So far, however, central banks are reluctant to confirm that. After all, if high-ranking central bank representatives were to give such statements, bond yields would probably fall quite strongly. This, however, is not yet something that central banks want, as they obviously seek more confirmation that inflation rates are sustainably on their way to levels consistent with price stability, especially with regards to core inflation rates. In our view, there should be enough evidence by mid-next year in order to justify first rate cuts, although probably at a slow pace. That's it for today. Thanks for watching and goodbye.